This is not just another conversation about market volatility. This is about a systemic failure that has been years, perhaps even decades in the making. And the fuse is currently burning down, not on Wall Street, but thousands of miles away, deep in the physical markets of the Orient. When you hear the name Eric Sprott, you should immediately recognize that you are dealing with one of the most successful, and often contrarian, voices in the history of capital markets, particularly concerning precious metals. Sprott isn't worried about the next quarterly earnings report or the Federal Reserve's next mild interest rate adjustment. His concern, his singular and persistent warning, is about something far more epical, a complete repricing of gold and silver that will not happen gently but violently, triggered by a physical inventory shock originating squarely in Asia. Let me reinforce that idea right now, because it is the crucial pivot upon which this entire discussion rests. We are currently observing a divergence so profound between the paper price of gold and silver, the price dictated by Western exchanges, derivatives, and algorithmic trading, and the physical acquisition price and velocity in the East, that the system itself is structurally unsound. What happens in Asia today is not just influencing the margins of the gold market. It possesses the kinetic energy required to shake the foundation of precious metals pricing forever. This isn't hyperbole. It is a mathematical inevitability based on depletion rates. To set the stage, let's look quickly at the comfortable narrative. For decades, the Western financial complex, the LBMA in London, the COMEX in New York, has effectively controlled the price of gold and silver through the issuance of paper claims, futures, and unallocated accounts. This system operates on fractional reserve principles, promising physical delivery for a tiny fraction of the metal they actually hold. As long as most market participants prefer cash settlement or rollovers, the illusion of abundance remains intact, keeping prices conveniently capped and stable for sovereign treasuries intent on maintaining the dominance of their fiat currencies. That's the consensus view, and it's a lie. The conflict, the deep-seated problem that Eric Sprott has dedicated the latter half of his career to illuminating, is that this paper facade is now colliding head-on with an insatiable, non-negotiable demand for physical metal originating in Beijing, Shanghai, Mumbai, and Ankara. These are not speculative traders looking for short-term gains. These are central banks, sovereign wealth funds, and hundreds of millions of private citizens seeking permanent, final settlement in physical ounces as an absolute hedge against geopolitical instability, escalating debt spirals, and the accelerating erosion of the US dollar's purchasing power. They are taking delivery and placing that metal deep inside their borders, ensuring it never returns to the Western banking system's grasp. And here is where the tension truly builds. The rate of physical absorption in the East is drastically outpacing global mine supply and the reported reserves in Western vaults. We have open loops of supply deficits now stretching into years, especially in silver, but increasingly so in gold. What happens when the vaults that back the derivatives contracts are fundamentally empty? What happens when a major institution or perhaps even a major Western central bank suddenly demands physical delivery in size, only to be told, either explicitly or through bureaucratic delay, that the metal simply isn't there? The crucial catalyst for the global shake is understanding the role of the Shanghai Gold Exchange, or SGE. Unlike the COMEX, which is primarily a cash settlement betting parlor, the SGE is a physical market delivery system. When they report withdrawal numbers, those are ounces leaving the system to be owned and stored, never to be rehypothecated. And those withdrawal numbers are staggering, often dwarfing the official reported gold accumulation by the People's Bank of China, PBOC. This implies two things. First, that China's true official accumulation is likely significantly higher than reported, and second, that Chinese citizens, aware of the macro-tectonic shifts, are buying physical metal at a pace that constitutes a quiet, systematic bank run on Western precious metals inventories. They are acting as sophisticated collectors of wealth insurance, understanding that fiat currency is simply a promise, while gold is the ultimate final settlement asset. We are talking about a flow dynamic where hundreds of tons of gold are being transferred year after year from the supposedly safe vaults in London and New York, vaults that support the paper price, into the non-rehypothecatable vaults of Asia. This drain is structural, persistent and accelerating, creating a situation where the physical metal supply in the West is approaching a point of critical failure. Sprott's thesis is simple, yet terrifyingly potent. Eventually, the fractional reserve nature of the COMEX and LBMA will meet a demand shock, and the paper contract holders will discover they own nothing but an empty promise. That, my friends, is when the paper price fails and the real price is discovered. If you are finding this deep dive into the underlying physics of the gold and silver markets compelling, make sure you hit that subscribe button right now and give this video a like. We need to cut through the mainstream narrative and reveal these fundamental truths about real wealth preservation. Let's zero in on silver for a moment, because Sprott often argues that the silver market is even more acutely strained than gold. Silver is simultaneously a monetary metal and a crucial industrial commodity. The energy transition, the massive push toward solar panels, electric vehicles, and 5G technology has created a structural supply deficit that is not cyclical. It's permanent until a massive new mine supply comes online, which takes years. Asia, being the manufacturing hub of the world, is consuming industrial silver at an unheard of rate. When you factor in the persistent physical demand for silver bullion from India, driven by cultural affinity and inflation hedge, and combine that with the industrial appetite from China, the available above-ground inventory that backs Western futures markets is dwindling rapidly. We are seeing major exchanges' silver inventories drop to levels not seen in decades. This sets up the ultimate pattern interrupt, a dual squeeze driven by both monetary flight and industrial necessity. This brings us to the ultimate re-engagement point. You must understand that this looming crisis, catalyzed by Asian demand, is not about gold moving from $2,000 to $2,200. That's noise. This is about a generational, multi-bagger repricing where the market attempts to find a true clearing price for a scarce physical asset in a world drowning in fiat debt. Eric Sprott is essentially warning us that Asia is setting the floor under the metals, guaranteeing that the Western paper games cannot push the price down indefinitely. They are the ultimate physical buyers, and they are buying with a long-term strategy rooted in the eventual collapse of Western currency hegemony. The climax of this structural conflict will be the moment of disconnection. The price reported on CNBC, the paper price, will become completely irrelevant. Why? Because you won't be able to buy physical metal at that price. When the COMEX fails to deliver physical metal in a significant way, even once, the confidence in the entire fractional reserve pricing mechanism evaporates instantly. The world will suddenly realize the scarcity, and the price will rocket toward whatever level is required to coax the last available physical ounces out of the hands of stubborn holders, likely measured in 5 figures for gold and triple digits for silver. The events unfolding in Asia today, the relentless, systematic vacuuming of physical gold from Western centers of power, are the countdown clock ticking toward that moment. China is strategically positioning itself not just to survive the eventual fiat collapse, but to emerge as the financial superpower post-crisis, backed by thousands of tons of real, hard, unencumbered gold. They are executing the ultimate long-term trade, recognizing that the only way to avoid the fate of debt-ridden Western nations is to secure the world's most stable form of wealth transfer. This is the Shake Forever event. It is the permanent separation of the physical reality from the paper fantasy, and it is being triggered by the massive, hungry demand that only the East can muster. The risk is not in owning gold or silver. The risk is in standing on the sidelines when the final inventory is taken. The Asian markets are signaling their intent clearly. They are preparing for a world without reliable Western currencies, and they are using physical precious metals as their lifeboat. The velocity of physical transfer accelerating right now is the most crucial financial indicator for the next decade, far more critical than any interest rate statement. We are witnessing the final stages of the great wealth migration. The question you must ask yourself is, are you prepared for the inevitable repricing that follows when the music stops and the Western vaults are found to be bare? Study the SGE withdrawal rates, monitor the LBMA inventory levels, and understand that time is running out to prepare for this shift. This is just the beginning of understanding the magnitude of Eric Sprott's warning, and there is so much more depth we need to explore regarding the precise timeline and the immediate fallout when this structural imbalance finally corrects itself. We are currently watching a massive geopolitical arbitrage play unfold, and the stakes could not be higher. We discussed the relentless physical flow from west to east, the foundational imbalance that underpins everything Eric Sprott warns about. But we must now escalate this analysis from observation to imminent threat, because the issue is no longer if the system breaks, but how violently and when the paper contracts in London and New York finally give way to the reality of physical scarcity. The vast majority of participants in the Western financial machine treat gold and silver as abstract financial derivatives, purely tools for leverage, shorting, or synthetic exposure. They rely on the foundational, yet fundamentally fraudulent, assumption that the physical metal backing these obligations is always available, or that delivery will almost never be demanded. This is the critical juncture where Asia enters the frame as the wrecking ball. The banks, miners, and Western central banks are sitting atop a pyramid of paper claims that may exceed the actual readily available physical gold by a ratio as alarming as 100-to-1 in certain trading windows, especially concerning silver. This ratio, this extreme degree of fractional reserve leverage, is the core tension. The entire Western pricing mechanism is dependent on the continuation of low demand for physical delivery. If a small percentage, say just 1%, of the paper claimants decided simultaneously they want their actual metal, the system goes instantly bankrupt. Now consider the massive sovereign and state-affiliated wealth funds in Asia, the massive import figures out of countries like China and India, and the highly strategic buying patterns we see emerging from the Middle East. They are not buying paper claims. They are acquiring tons, building vaults, and implementing national strategies predicated on the intrinsic value of these metals. For them, gold is not an investment. It is insurance against Western financial instability and reserve currency debasement. What Eric Sprott suggests, and what I believe to be the inevitable conclusion, is that one major action by one or several large Asian entities will serve as the pin that pops this paper bubble. This won't be a minor buy order. This will be a coordinated, highly visible demand for settlement in physical ounces that the COMEX or LBMA simply cannot meet without resorting to extraordinary measures, and those measures will expose the fraud instantly. Imagine a major Asian central bank, having accumulated hundreds of tons of physical metal discreetly, choosing to exercise a significant tranche of their existing futures contracts. They do not roll them over. They do not accept cash settlement at the suppressed price. They simply demand the metal in the vault verified. This single move is not just a financial transaction. It's a geopolitical statement that breaks the Western pricing cartel. When the clearing banks and custodians scramble, they will first try to bribe the counterparty into cash settlement. But if the counterparty, the entity in Asia, refuses and holds firm, demanding only the ounces, the mechanics of failure begin. The failure mechanism is critical to understand. When the bank realizes it cannot source the required physical metal without triggering a massive panic, i.e., buying it on the open market at whatever price necessary, they are forced into a force majeure or settlement failure. They will offer a high cash settlement, but this cash settlement confirms the scarcity and validates the true monetary value of the metal. The Asian buyers will take that cash, immediately re-enter the physical market, perhaps the Shanghai Gold Exchange, or directly through mining deals, and buy even more ounces at the suddenly soaring spot price. This is a feedback loop from hell for the short sellers. This is the pattern interrupt that causes the real escalation. The moment one contract fails to deliver, the entire market loses confidence. Every other short position, every derivative holder, every institutional investor who previously trusted the system's ability to deliver, suddenly realizes their exposure is to counterparty risk, not metal value. The rush to convert paper claims to physical reality will begin. And I must emphasize this point clearly, because if this detailed analysis is helping you grasp the scale of this coming shift, please remember to hit the like button and subscribe to the channel. Your support ensures this critical message, often suppressed by mainstream narratives, continues to reach those who need to prepare. The core of the crisis will be the instantaneous repricing. For decades, the price of gold and silver has been determined by the deep pockets and unlimited supply of paper, offered by the major banking institutions seeking to keep the dollar dominant and inflation expectations low. Once the physical supply bottleneck is exposed, the price discovery mechanism flips from being paper-driven to being scarcity-driven. The price will not move in increments of $10, or $20. It will gap. It will leap hundreds of dollars overnight, perhaps thousands, until a price is reached that finally stops the flow of physical demand. When you look at the total amount of global debt, global money supply, M3, and compare it to the total tradable above-ground gold supply, you quickly realize that for gold to fulfill its historical role as a true monetary hedge, its price must be orders of magnitude higher than it is today. We are talking about gold prices that fully reflect the debasement of the underlying fiat currencies. This is what Eric Sprott means when he says the event could shake gold and silver forever. It means the end of the manipulative suppression era. It means the paper short squeeze, which has been simmering for years, finally explodes into a physical delivery failure. Why is Asia the key? Because they operate outside the psychological framework of the West. Western investors, even physical holders, often have a price target where they are willing to sell. Asian entities, particularly central banks and ultra-high net worth individuals, are often buying with an infinite time horizon. They are buying to hold, not to trade. Their intent to hoard means the supply removed from the market is permanent. Every ounce going east is an ounce that will not return to the COMEX vault. Let's look at silver for a moment, because the implications here are even more staggering. Silver is not only monetary, but also intensely industrial. It is consumed in solar panels, EVs, and critical high-tech applications, and that consumption is accelerating rapidly. The annual demand often exceeds annual mine supply, leading to a relentless drawdown of above-ground inventories. The small size of the silver market means that if gold experiences a delivery crisis, silver will experience a hyperbolic, almost irrational spike. The gold-to-silver ratio, currently suppressed, will collapse as silver rushes to reflect its true scarcity and utility value. A few strategic demands for delivery of silver, which are already impacting inventories severely, could lead to a complete industrial shutdown in the West, forcing a repricing mechanism far more violent than that seen in gold. The conclusion is definitive. The market is standing on a structural cliff edge built by years of paper leverage and synthetic supply. Asia's sustained, strategic, and unrelenting demand for physical metal is draining the reservoirs that Western manipulators rely upon. The failure of a single major delivery requirement in a major Western hub will shatter the illusion of infinite supply. When that happens, and it is a matter of time and arithmetic, not speculation, the metal will be repriced based on its true scarcity relative to the vast ocean of fiat currency created globally. The gold and silver markets will be permanently reset, returning them to their fundamental role as the only true global monetary assets without counterparty risk. The paper promises will be relegated to the dustbin of history, and physical ownership will become the only financial shelter that matters. This realization should not breed fear, but spur immediate action. Do not wait for the headlines announcing the collapse of the paper market. By then, you will be paying prices dictated by panic. Review your current portfolio allocation. If you believe in the inherent value of unencumbered physical assets, now is the time to secure your position outside the Western paper system's inevitable implosion. Consider joining the thousands of discerning investors who are actively working to protect their wealth from this predictable outcome. Ensure you have liquidity, but prioritize the physical. Your financial future depends on recognizing that what happens today in the vaults and trading pits of Shanghai and Mumbai is determining the survival value of your wealth tomorrow. Don't just absorb this information, act on it. Don't be a spectator to the greatest monetary transfer of our lifetimes. Secure your ounces now.